Hello, 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 everybody. It's your boy, Sean McLaughlin, Options Sean on Twitter. This is the All-Star Options Jam session for August 8th, 2024. How you doing? What a wild couple of weeks we've had here, huh? Volatility back with a vengeance. People getting freaked out. Markets moving fast. We're having engulfing candles. We're having closing on the highs, closing on the lows. Throw earnings into the mix. We just got a whole soup of craziness going on. I hope you guys are doing okay. Like many people, many of our positions getting touched up today, or I should say this week or so. It is what it is. But while we did have a couple of positions that stung us pretty bad, we have a lot of positions that we got out of where the losses weren't really all that bad at all. In fact, one of them turned out to be a win, which was a surprise win, at least to me. We'll talk about that when we get there. But before we get into anything too deep here, I got to drop the old disclaimer that everything we discuss here is for educational purposes only. I'm showing you what I'm doing with my money, and I hope that you are learning something along the way. All right, so let's get to it here. Let's talk about what everybody's talking about. VIX, right? Here's the VIX chart. We had just an unbelievable range in VIX on August 5th. That was Monday. Just an unbelievable range. We had a print of around 65. Now, VIX is not a tradable instrument, right? So there's nothing that printed at 65. I should choose my words carefully. It is a statistically derived data point, but still, we saw 65 intraday briefly near the open. I mean, unbelievable trading, unbelievable volatility. We're seeing premiums blow out everywhere. It's made for quite a while. We haven't seen a 65 print since COVID, I think, since the first couple of days of COVID. So, boy, it's been buckle your seatbelts. It's been like that, and even with VIX at a 25 right now, way off those highs, it's still higher than it's been since October, right? So, yeah, we're way off the highs in VIX, but VIX is still very elevated here. So this is we need to be treading carefully here in this market. Things are not going that swimmingly, right? Whether you're bullish or bearish, you're having a hard time. Markets are whipping around. You gotta, I mean, there's nothing wrong with not trading in this environment, but if you are trading, you'll be better served by trading smaller, right? Because you're getting big moves. So if you get it right, if you trade, let's say a half size position, if you get it right, you might get double what you would normally get as far as the move goes. Your win will still be about the same, but with half the risk, right? And of course, obviously your losses will be smaller if you're trading smaller. So this is a cautionary tape right now. We need to be trading with caution, need to be trading with defined risk. And we'll talk about that a little bit too. But defined risk is really what's keeping us in the game here. And I'll tell you where we did not have defined risk. We have a couple of trades here where we got really touched up, and no surprise, we did not have defined risk. So let's get to it right now. Let's just talk about, let's rip the Band-Aid off. Let's talk about the ugliest closed positions that we just got out of. Let's talk about Amazon first. Amazon, we were short naked puts. Now, we were short the naked puts. We put this trade on back on July 26th, I believe, or 29th, before the volatility spike. Did we know that volatility spike was coming? Of course not. We sold September 170 puts for 435 credit. Well, as we saw following earnings, Amazon did not have a good reaction to the earnings. Our stop loss level was 170. We closed below it the day after earnings, and we exited the following day. We closed there for 14.25. So we lost about $10 on that trade. That one stings, right? Now, it was a naked put, and it's a large priced stock. So I traded it very small. If you traded this too, I hope you did as well. When you have undefined risk, you want to definitely err on the side of trading smaller. Thankfully, in this case, for me, I mean, me personally, I traded one contract. All right. I was short one put. So that might sound like a piker position to some of you guys, but hey, undefined risk. This is why we trade small, for example, for reasons just like this. So we're out of Amazon. Similar ugly trade was our Berkshire Hathaway. the first time Berkshire has burned us in a long time. I feel like we've gone back to the well on Berkshire many times. It's treated us very well over the last 3-4 years. We entered a bullish risk reversal where we sold the September 14 or 415 puts and used those proceeds to buy the 455 calls. We did that trade for a 25-cent net credit all in on the day we got in, but we wanted to get out if we broke 418, and we certainly did that. Now, right now, we may be regretting our exit a little bit, right? We have quite a bounce since we got out. But, I refer back to this often when we have situations like this, that most of my best trades are the trades that begin working right away. And obviously, this one was not working right away. So is this trade going to go on to could have been my best trade of the year? Unlikely. I feel like at this point, maybe it'll turn out to be a winner had we held, but will it be my best trade of the year? Probably not, given what has happened. But either way, we're out. We paid $970 to get out of the trade. That one stings too. But hey, that's really the worst of it. Okay. The rest of the exits here, we have one winner, but the rest of them were surprisingly small given the situation that we were recently in. So in no particular order, let's go through it. Here's Bank of America. We were in the December 45 calls. We paid $1 for way back in May 17th. Well, when we were below 40, that was our trigger to get out. We exited the next day. We got out for 50 cents. We paid $1 for them several months ago and got out today for 50 cents below where we got in. To me, that's a surprising price, right? If I would have thought we would have been lucky to get 25 cents, right? So, hey, not a total loss. We'll take it. Next up, Wolf. We were long a bull call spread in January options, long the 5 calls and short the 7 calls. We paid 35 cents to get in back here in June, early June. We got out when we closed below 4. We got out the next day. We got out for 20 cents. So we paid 35 cents to get in, got out for 20. So we lost less than half again. To me, that's a surprising outcome, better than I would have guessed. And we'll talk about why this is occurring once we get through a couple more of these trades. But this is a unique situation here. Let's talk about Tesla. Here's one where we got out for a profit. All right. We were in a January 200-300 bull call spread that we paid $18.50 for back in early May. Yes, the stock is higher from where we got out or from where we got in, but boy, did we have a wild ride in this thing. But we were able to get out for $26.20 the other day. So we paid $18.50, got out for $26.20, so almost $8 on the trade. That's a win. Hey, it feels good to put some points on the board here. But here's the thing that's important about what's common with the Bank of America trade, the Tesla trade. What else we talk about? The Wolf trade. Here's the thing, guys. We were long premium in these trades, right? Whether it was a bull call spread or just a straight call, we were long premium. And obviously, when you're long a call or long a call spread, you are betting on the price moving higher, right? You have positive delta. So any movement higher in the price of the stock should result in increased or should result in profits when you have a position with long delta. But what is less commonly discussed when you are long calls or long a call spread, you are also long volatility. Being long an option inherently means you are long volatility. And when we had VIX going crazy, tripling overnight or whatever it did earlier this week, that represents an increase in premium. And so even though we had the direction wrong on some of these trades, the volatility was keeping a bid in the price of the calls. So what that means is that when we got out of the calls, we didn't take as much of a loss as we might have otherwise taken at that chart level in a normal market, because the premiums and the calls were still very rich. So that actually cushioned our losses. So that's why in Wolf, we didn't lose a whole lot of money. That's why in Tesla, we made money. And that's why in Bank of America, we didn't lose a whole lot of money, because as volatility screamed higher, it actually put a bid in the calls. At least it kept the floor on the calls, right? So Wild times we live in right here. Let's just complete the task here. Let's go through some other trades that we've exited. We had an iron condor in an XLK. This is a delta neutral credit spread. When you put a trade like an iron condor in, you are betting on a range holding. Well, the range we were betting on holding was 205 on the low side and 245 on the high side. Well, clearly we broke below 205. That means our thesis for being in the trade was wrong, proven wrong by the market. Only price pays. Only price is the only thing I pay attention to. And the price was telling me we are wrong. So we had to get out. I closed it for 481. We initially collected 240 on the way in. So, hey, worst case, we could have lost 10 bucks in this trade. Or we could have lost, excuse me, we could have paid $10 to get out. Instead, we only paid 481. So it's a loss. Losses suck, but it could have been far worse. Next up, Morgan Stanley. We were long the December 105 calls we paid 10 bucks for back over here when this stock was trading just below 100. It was looking great. This stock was really looking great for us, but as you can see, it unwound pretty quick. But man, we got out for 715. Again, surprising. That is a surprising price, a price that I'm very happy about. If in a vacuum, if I would have just pulled this chart up one day, not knowing what's going on in the market and just looked at this chart, I would have guessed that we would have been lucky to get $3 for that call, maybe even less, right? So we paid 10, got out for 715. That's not a bad loss at all things considered. We will take it. Next up, XLE. This was a what do we call it? This is a leap. This was a long-term trade back in early this late winter, early spring. We were making the bet that energy was about to go on a secular bull market run that would have a long way to go. And we purchased December 2026 calls. Those are leaps, ladies and gentlemen. More than 2 years to expiration. We had the 130 calls. We paid $5 for them. Well, I think we marked the top within about 5 or 6 days. It's done nothing but go down for us. Our final line in the sand was 89. We closed below it earlier this week. So I pulled the plug on this trade. I got out for $1.66. I may come back and revisit this trade later on because, again, this was a longer term trade. It's got a long time to play out for us, but I would be much more interested in getting back in if we can get back above 95. Maybe 97 area. But for now, we are out of the XLE leaps. And finally, just this morning, we pulled the plug on our Wheaton Precious Metals. Again, not a surprising loss here, though. I mean, or I should say, a surprising loss in the fact that it wasn't that much. We were in a call calendar spread where we're long the 65 calls in January and short the 65 calls in September. And this too is a long volatility trade. When volatility rises, the value of this spread also rises because we're long the January calls, which have longer to expiration than the September calls. And because there's more time to expiration, when there's a rise in volatility, the further dated option will see a bigger change, a bigger effect due to the volatility change. And so we got into this trade on July 8th, I believe. We paid $1.65 for it. Well, guess what? The stock is below where we got in, and it's 2 months later, almost, or a month later, excuse me. And we got out for 161. We only lost 4 cents on this trade. Why? 2 reasons. The value of those September 65 calls has collapsed. There's not much left there. And there's a bid in those January 65 calls because of the elevated premium. The elevated premium, the elevated volatility has put a bid in those calls. So the long calls held their value, and the September calls, well, just theta's getting away from them. So that's taking that away. So closing this spread for $1.61, it's a loss, but it's 4 cents, right? Not bad. We will take it. So to sum it up, we had a couple bad losses, and it's no surprise that the couple bad losses were in our undefined risk trades. Maybe this will be a lesson for all of us. Maybe we should do less undefined risk trades. I'm not opposed to that. I mean, I do undefined risk trades because sometimes they're tactical and they work, and most of the time they work. They have a high probability of success, but boy, when they don't work bad, right? And we had two examples of that with Berkshire and with Amazon. Makes me not want to do a whole lot of undefined risk trades going forward. Of course I will, but at least at the moment, I want to stick to defined risk. And this is the type of environment where we want to stick to defined risk. Now, we talked about some of these trades before about, we haven't taken those such a big loss. I talked about it on the morning show if you guys were in this morning, but there's a lot of people right now, both on my analyst team at All Star Charts, as well as other smart people I talk to, a lot of people thinking that in this environment, the go-to move should be selling premiums, selling naked puts, selling put spreads. Well, we've already touched on why we don't want to sell naked puts right now, right? This is a market where we could have from here, we could have a big move in either direction. We could have a big bounce, which, if you sell puts, you're going to look like a genius, but your upside is limited. You're only going to earn what you sold for those puts. Or we might have another leg down, which could be even scarier. I don't think we'll see a VIX at 65, but I think we could have another leg down possibly. And if that's the case and you're short naked puts, you're going to get hurt. If you want to play for a bounce here, which I'm open to playing for a bounce here, certainly in stocks that have shown relative strength in this market. And in fact, some of our open positions are stocks that we have a lot of open relative strength in right now. If I want to play for a bounce, I want to play for it with defined risk for all the reasons we've talked about. But I would rather play it by buying call spreads, buying a call vertical spread. That means buying a slightly out of the money call and selling a further out of the money call. The further out of the money calls have a lot of premium. Okay. So we could sell that to put the trade in our favor. And here's the thing, guys. If the stock goes up, great. We're going to make money. We're going to have the direction right. Volatility is going to come in. So the premium and those out of the money calls is going to come in. That's going to benefit our position. Great. But if we have another leg down in the market, we're likely going to see volatility rip again. Again, probably not to a VIX 65, but we're probably going to see a meaningful increase in volatility and therefore in options premiums. And if that happens and we're long, so let's say a call spread, we might have the direction wrong and we will probably lose money in the trade, but we probably won't lose as much money as we normally would because there's going to be a bid putting in a floor in the prices of calls because of the elevated volatility. So in this environment, if you're looking for new trades, I think for my money, buying call spreads these days, right now, for the next few days at least, seems like the good move. All right. Usually the next segment we talk about here is we talk about updated stops, but guess what, guys? We've got no stops. I don't know what happened on my screen here, Gene. Let me fix that for you real quick. Boom, boom. Sorry, a little technical malfunction. There we go. We have no updated stops. We have all the positions we have on now. The stops are not changing, right? And that's reflective of type of environment we're in. Generally, our stops are updating because positions are moving our way and we're raising our stops. But let's just talk about some of our open positions and just to show you why they're not updating. Here's Caterpillar. It tested our stop loss level, but rebounded nicely. So we're still in CAT. GE also same story, tested our stop loss level, but closed above it. So we're still riding that. Microsoft, well, that's a trade we got into recently. We'll talk about that in a minute. eBay hanging in tough. Given the market environment we've been in recently, eBay's hanging in real tough. AZN, same story. We're about a couple of bucks away from a new all-time high in AZN. How about that? RSG, better to be lucky than good sometimes, but we caught this turn. We bought this turn here, and so far it's working. So yeah, we don't have any updated stops here to talk about, but let's talk about our recently opened positions. And guys, for those of you who maybe are watching me for the first time or are new here, every trade that we put on, and we'll talk about these trades here, every trade that we put on, we publish a detailed piece about why we like the trade, what about the setup it is that we like, how we're trading it, what option strategy we're using, where our stop loss levels are, where we will take profits, if at all. We lay out all those details in the trade plan. If you want those details, simply go to allstarcharts.com, head to the members section, head to the options section and you'll find all the detailed trade plans there. If you don't have access to that, please shoot us an email, info@allstarcharts.com, and we'll be happy to get you hooked up. But real quickly, we'll go through these trades without giving away too many details. And we got into Pepsi right here on August 2nd. This was Friday. We put on a delta neutral credit spread here. We're betting on this range holding. Next trade we did was Honeywell, similar trade. We're betting on the range holding. We're selling premium here, delta neutral. So far, so good in Honeywell. And then the next new trade we put on, we put this on Wednesday. Yeah, yesterday. We got a bullish trade on in Microsoft here. We are betting that the worst is behind us, and Microsoft will be one of those names that will lead the charge back higher, at least back to the test of the highs. We feel pretty good about Microsoft, so we put a bullish bet on there. Again, all the details at allstarcharts.com. All right, everybody. So there's no updated stops. If you have any questions about anything we've talked about here today, about anything at all, shoot me an email, info@allstarcharts.com. And as I like to say at the end of these shows now, if you like the charts that I'm showing here, check out my friends trendspider.com. They've hooked us up. They've hooked you up. If you want to start a subscription at trendspider.com, you could use my promo code Sean50 at checkout and get 50% off any new subscription plans for TrendSpider. I've been using it now for the better part of the year. I love it. I think you will too. So if you check them out, tell them Sean sent you. All right, everybody. That's all I got for you. Hang in there. I think the worst may be over. I think we may probably retest the lows just to see if the lows are for real. So expect big moves in either direction over the next week or so. Some people call them aftershocks. You know, just think like a big earth. We just had a big earthquake, and there's usually a few aftershocks following a big earthquake. So hang in there, folks. Defined risk as your friend. Don't do anything crazy. This is no time to be a hero. This is time to be smart, to be tactical. And when all else fails, be small. All right, everybody. Take care. We'll see you next week.